that I saw. Got it. Start broadcast. I know that some of us are financial advisors, and some of us are financial professionals. The distinction there is when you are registered with the SEC or FINRA, meaning you have your Series 7 or 6 or 65 or 66, that is, then you can call yourself a financial advisor. And some of you are that and do business in securities and variable products, and some of you don't. Some of you are looking to add that. Some of you might be just a Series 6 now, and you're looking to become a Series 65, which means you're allowed to add, to pay, charge fees. You get paid a fee for managing somebody's assets under management. I will tell you that that is the direction the industry is going. Whereas 30 years ago, this really didn't even exist. All we got paid was commissions. We sold a mutual fund and got paid a commission for that, either a front end or a back end. Or we sold a variable annuity and we got paid a front end load, meaning a commission for doing that. Today, even variable annuities are going in that direction, where today you have to have a Series 6 to sell a variable annuity. And we sell a lot of them within this firm. In the future, you could sell that with just a 65. They're changing the fee structure of that and filing it with the regulatory bodies to be able to do that. What I wanted you to see was this article that I just saw here, and that why you would want to, if you want to get into this area of business of working in securities, why you would want to be probably a 65 or a 66, and an RIA, a registered investment advisor. And I'm looking down here at these 7 reasons. I'm looking here at number 6. Understand how they are getting paid. Some advisors are fee only. Others charge a percentage of your assets under management. Some advisors are paid commissions by mutual funds. A serious conflict of interest. This is sad that this is coming from this company. That is not a serious conflict of interest. I mean, that is how most of the people operate still in the financial world, is they financial advisors and investors invest in mutual funds or exchange traded funds or variable annuities or what have you, and they're paying a commission. And this is what you're up against. You're up against articles like this that say that's a serious conflict of interest. And that's not true, but that's what we are battling. And so it's just, the encouragement would be is if you're long for this industry, if you're going to want to grow in this industry, the encouragement would be go get your Series 6 or 65. It is definitely the way the Department of Labor and the high regulatory bodies are driving this business, and just kind of saying it's more ethical. It's more ethical for you to get paid a fee on somebody who gives you $100,000 than for you to get a commission. That's not true, but it is the trend in the industry. That's why when, for instance, Eric Nagel got all his licenses earlier this year, took a big chunk of time. It's hard to do, although this is a time when people do it often is at the end of the year, over the Christmas holiday. I'm not going to see as many clients, so I'm going to take some time out and go get licensed. And if I encourage anyone and everyone to get their RIA designation, or that do the tests that get you that, either the 65 or the 66. And there's a combination of the way that you do that. And Colleen could tell us, as our compliance guru, if you're going to get the 65, I think you got to start with the 65. Is that how that works?
Not necessarily. If you can have the 65 only, but if you want to get the 66, then you have to at least attempt the 7.
Okay. Either of those deals allows you to get paid a fee for managing money. And I would tell you that that is the direction that the industry is going. All right. That's just my little plug on continuing advancement and rounding out your practice and getting in that direction. Let me stop that. Not that.
Yeah, Dennis, can that be distributed, that article?
Sure. I'll send. Sure. Yeah. I'll send it to Colleen. She can send it. Sure. And the other thing, the other thing I would say is never run away from this business. We have a number of people within the firm that are licensed and proficient and growing out in that capacity. And so if you have people who say, can you help me manage my money? And say, yeah, I work within a team that does that. I can, that's why we're such advocates for joint field work. Hey, I didn't stop the broadcast. You guys still there?
Yes,
I get little notes on my thing. All right, good. All right, cool. So yes, we will broadcast that and never run away from business. We always have, that's we're good connectors, just like on we don't do Medicare supplements necessarily, or one wasn't, but we have people within the firm that do. So then we can take care of that business and bring in the experts, and we can make you whole, meaning you can get share in that compensation in one way or another. We'll figure it out. And most important is take care of your client. All right. So given that this is the Medicare and Medicare Advantage season, this is also the tax planning season. And people defined benefit, defined contribution. People realize at this stage of the year how much money they're making, especially people that are on some type of variable compensation. Business owners, I just had breakfast and first topic was how's your year going? How's revenue this year between the two of us? Both of us are business owners, having a good year, not having a good year. And with revenue comes planning. And so it's not only business owners, it's like real estate agents, it's doctors, it's lawyers. And let me ask you this: why do business owners put retirement plans or qualified plans, employer-sponsored qualified plans in place? What would be your answer for that? Why put a retirement plan in place for your business? Any answers?
Yeah, competition.
Yeah.
I mean, basically other companies have plans and things to offer their employees. So if you want to attract people to your company, you have to have one too. There's tax advantages, write-offs when you contribute, on and on.
Exactly.
Retirement planning, estate planning, transition planning to sell your business to somebody else.
Yeah. All very good answers. I do it for myself as a business owner for estate planning and my own retirement. And I'm doing it for my employees because I want to be competitive with the market. It's a retention deal. I do it for taxes. I saw Rob Hanna put that out there and say, you know, because a qualified plan is one that I, as a business owner, get a write-off for. Anything I put into there, I'm not paying taxes on. The more I retain as a business owner, the more I'm going to pay in taxes. And so all of those are exact reasons to do it. Goodness, retention, competitive market, self reasons, my own retirement, my own transition, my own tax situation. So as far as qualified plans, and we call this qualified plans, and they're qualified because the business gets a deduction for doing them, and they are written into or allowed by the Internal Revenue Code. That's why these things have numbers, because there's this big book, the Internal Revenue Code, and it's classified by different numbers, and that's why how a number of these different plans get named is by the code that is associated with them. So anyway, give me some examples, and qualified plans fall into two large categories, DB and DC, defined benefits. The benefit is defined, or defined contribution. The contribution is defined. So give me some examples of these qualified plans.
You mean like a 401k?
Yeah, there you go. 401k is a qualified plan. It's a defined contribution plan because the contribution is defined by the code. What is the maximum an employee can defer into a 401k this year?
I think it's 19.5.
Very good, Jeff. 19,500. Exactly. All right. Do we have another example of a qualified plan? Keogh is an old plan. They're HR 10s. That is one. Yes. And they're still out there. Yep. That's an example of one.
403Bs.
Yeah. 403Bs are exactly that of a 401k, if you will, from a nonprofit. So a hospital, a school, a church are the special code for defined contribution plans that are run by nonprofits. Also in this area over here, a profit sharing. So let me ask you this, and defined benefit what's the big word for defined benefit? Pension plans. And most plans today fall in this defined contribution category because the onus of responsibility is much more on the employee to put money into it. The employer can set up the plan, and then maybe do a match, like your match with One America, if you choose to participate in their 401k. And right away you're saying, wait a minute, I thought we were independent contractors. You are, but you're in a special provision that allows you to be a statutory employee when you're a career agent, and they offer a 401k, One America does, and you can withhold up to 19,500 and contribute. And One America will match dollar for dollar for every dollar you put in up to the first 6% of your earnings. They'll put in $1 for every dollar you put in. So if you make 100,000 in first year commissions and bonuses through One America's career channel, you defer $6,000. One America is going to go and put $6,000 in. That's a defined contribution. Most of that is on you. They don't have to match, companies don't, but a lot of them do. That's another tweak or benefit or Benny that they put with this. The employer can also choose to add to these 401ks if they wanted to, or 403b, or profit sharing, or simple is another. A simple plan is another. A SEP is another plan. And generally, the maximum you're going to get between the deferral part that the employee puts in and the amount that the employer could put in, you're not going to get much greater than $57,000 a year going into it. And that would be very unique. That's a employer putting in a bunch themselves and then the employee putting in some to get up, and there might be some catch-up provision in something like that as well. So that's what you're looking at on the defined contribution side. Pensions are created and contributed to by the owner. And why do people love pensions? Because they're guaranteed, because it was provided by my employer. And so that's why we saw, starting in the 1980s, this great migration from large pension programs to more defined contribution plans. Doesn't mean that pensions still can't be created though. And the ideal situation is the pension for the individual owner. So an owner that has his own business and has 0 employees, or he is his own employee, or has very few employees. And this unique part of the tax code, a lot of people aren't even familiar with. You know, I was just plugging in last night into Wikipedia 401k and looking at the contribution limits and the catch-up provisions. When you're old, then you can put in extra to catch up, is what it is. Generally after age 50, you can put in an additional amount. I put in 403b and saw there, and I put in a 457, and it's actually a non-qualified plan. Or I put in a simple and looked at those kind of things. And I put this one into 412E3 into Wikipedia, and it didn't even come up. Now you can do an internet search on them. It's a very unique code to create a pension, and it's ideal for the small business owner, highly compensated. And the reason why is because it provides the greatest tax deduction out there. And so what you're looking for here in this, and honestly, we are whale hunting to some respects in this situation, because it's rare and it's a big dollar amount. But I'm already familiar with a couple cases that have been done with One America so far this year, and we're actually working on some within this agency or within this firm. The key here is your client is looking for a very large tax deduction. That's the key in this. So when you're thinking about this, you're thinking about some owner that doesn't have very many employees, maybe 1, maybe 2, maybe none is ideal, and wants to and is going to get hammered with taxes because they've made a lot of money this year. And by a lot of money, they're making substantially over 100 grand. They're into the six figures. Let's just say they're making $500,000. So this is an attorney. This is a surgeon. This is a engineer that consults out. This is a software designer that has got some very unique things. And this isn't a one-time. Their income is somewhat predictable, meaning they expect to make this 500,000 for the next foreseeable future, because we need to contribute to this thing at least for 5 years. And when I'm talking maximum tax deduction, no other plan allows the amount that is available through the 412(e)(3). And as much as $230,000 in 1 year. 100% of compensation up to 230. So this is a person who's this 500 grand. That's more than enough. Often you find them and they've been making good money and they've been socking it away and they've been putting it in their own portfolio. And now they're 50 some years old and they're saying, you know what, I want some guarantees. I've got my portfolio out there and man, I'm getting hammered with taxes and taxes might go up and I'm looking to defer as much as possible. And one of the other very, very unique things about this type of plan is that because it's a pension, it needs to go into guaranteed products. And so what are guaranteed products? What products have guarantees? Life insurance and annuities. And so One America sells both of those in a very traditional, very conservative, very predictive, but very good for good rate of return for guarantees. And so you can put 50% of this 230,000 in a life insurance premium, in a whole life insurance premium. And it's all base. It's not overfunding it because it has to be guaranteed. So we're seeing that people who maybe didn't do a lot of planning along the way, and now they're making big money, and they haven't socked a lot away, and they have other needs, like David kind of alluded to. They have maybe an estate planning need. They have a transition of that business need. There is a need for life insurance out of this plan, and they want to create a lifetime income. Well, then they could put 100 grand a year for the next several years into a fixed annuity, and they could put 100 grand a year into a whole life policy. The unique thing is these things can be then created for distributing that income as a pension would. Pension, then we turn it on like we turn on Social Security, and you get an income for the rest of your life. And the income is guaranteed as long as you live. And that's why you use an annuity vehicle. And you can convert the life insurance cash value into an annuity vehicle if you wanted to. Often, though, these 412(e)(3) plans are created and then they are converted in retirement, and they simply cash them out, or they convert and keep the life insurance, or they don't necessarily stay this way. The biggest reason people are doing these are to beat the tax man. So your clear that. Your prospects in this again, are self-employed people. People who are 45 or older. People who have very few employees or none. Very few employees or none. Their number one reason, and so your conversation is how is your tax situation going to be this year? They're looking to get the largest tax deduction possible, and there's no other qualified plan than the 412 that allows for this amount to be deferred from their taxes. So I mean, if I'm putting 230 in a plan and I made 500, well, now I'm at 270 and I'm reducing from there on my other deductions, my charitable deductions, my standard deduction, my home owners, mortgage deduction. So I'm really bringing my income down, often into another marginal tax bracket. Again, just having this kind of conversation with people can sometimes say, well, yeah, there's no way I'm not in that kind of limit. Sometimes you're just saying, you're just showing your competence and your level of that there is such a plan where you could sock away that kind of dollars, but then that you determine from doing their analysis that that's not where they're at. They don't have the ability to put away that kind of those kind of dollars, or have no desire to put away those kind of dollars. But maybe something else comes into play. Maybe a non-qualified plan comes into play, or maybe a simple plan or a SEP plan comes into play for their situation. The deal is know that these exist, because every once in a while you will stumble into one by knowing this knowledge. Key really good actual people for this: doctors, attorneys, dentists. Do you know how much dentists make? They just kill. Some of them have huge staff, some of them are solos. Chiropractors, again, some of them have big staffs. A lot of times those staffs, though, are not employees. They're independent contractors. They're massage therapists. They might just have the person who is the front desk people. Accountants. This is also a really good concept to share with accountants, because they know people's tax returns and people are coming to them. That's probably, if you have a good relationship with an accountant who's doing taxes and does taxes for business owners, this would be the first person I went go and tell and share this concept with. Have you ever heard of the 412 E3? It used to be called the 412I. It did change in the tax code, but nothing changed with it. It just changed because the labeling system changed. You do need a third-party administrator for this. Third-party administrator are pension administrators, and there are experts out there. So you don't have to even know how this works. You just need to know, I know this is out there, and I know people are looking for big tax deductions, and is this something that you would be? Then you bring in this third-party administrator and the pension designer, and they get all the legalese and pieces put together.
Well, that gentleman was on a few weeks ago. Steve, I don't recall his last name.
Steve Toth, yes?
Steve, oh,
Yeah. So he's a pension designer. So really big life and, well, I mean, people in the life insurance industry who are familiar with this run into a case like this and they go, I don't know how this works. I don't even, I wouldn't even know where to start. I wouldn't know, and because it's a pension, it has to be determined by the person's income level and their age. And so then they do the calculations, and he comes up and says, you need a whole life policy, Dennis, that has $132,000 a year going into it. And there's some going back and forth with the client and them understanding the situation, and then them saying, yes, could I fund 132,000 for the next 5 years? Yep. And at the end of the 5 years, I might retire, and then I might buy that thing right back out of that pension plan or whatever. But this is huge to get this tax deduction for the next 5 years. And so the pension designer is gonna do all the difficult work in this kind of thing. For that, he's going to take a split on the business. Typically, Steve is a 25%. I'll design it. I'll help you put it together. I'll help sell it. I'll be the technical person. You bring the client to the table. He's contracted with the big life insurance companies that are really good in this space. One America, Mass Mutual, Lafayette Life. We have all of those available through our IMO, so I mean, if a person is partial to one way or another, we can get it done. And then you got to go get a TPA. So Steve has a TPA that works with him. If there's also a number of them that are local. Dan Runzer, our 401k guy, has a number that are in his file, in his tickler file, or in his phone, that he can make a recommendation to, who are very familiar with these types of plans. You're the rainmaker. You're the connection. You're the business owner, and you bring this idea to them, and they go like, wow, I never knew you could write off that kind of business, and I can sock this away, and it's all my money. Sometimes you'll have a business owner who's a little bit selfish or a little bit ruthless, and he has, some employees. They got 5 employees, they got 10 employees, and it's like, do you have a retirement plan in place? No, I don't. I'm not putting anything in for those guys. It's expensive, and they just leave me or whatever. Well, with something like this kind of plan, you can do a carve out sometimes, and and if I can put this kind of money away for me, and I put a little bit of money away for them, and you can question the morality or the niceness of the business owner, but that's sometimes why they do it, because there's just this incredible discrimination that can be done. I can put away a ton of money for me, and I don't have to put away that much for them, and I can write it up as a executive carve out, and there's rules on that. And again, there's pension designers know all about this, and these TPAs know all about this. You're just bringing the person to the table, getting the illustrations in place. They direct you on how to do all of this, and can turn out pretty good. Good question. Other questions on something like this?
Yeah, this can be layered, can it? So in other words, if they have a 401k or a SEP already and have maxed it out and looking for another place to get deferral on their taxes, so it can be combined with another type of retirement program.
Yes, you can have more than one qualified plan in a program or in an employer situation. Yes, there are maximums that can be income levels, like, okay, because you're already putting this into this plan, you can't put as much into it if it was a standalone. But yes, because of this high levels, the short answer is yes, it can be layered. You can have more than one plan in a particular situation. Good question. I also have, so In our own advanced marketing department of One America, Kelly Hall is very familiar with these plans. She's a CPA. Some of you might remember Clay Summers works in the advanced marketing department. He has a piece out there that will send out in follow-up to this that hits on a number of these things that I went over as well. One pager, great piece to, fire off to some of your, well, it's probably an internal piece. Yep. For use with financial professionals only. Well, okay, so don't mail it to them. Go and visit them and show it to them. But we'll send that out at the conclusion of this as well. Good. Any other questions? You should be thinking of your wealthiest business owners, your most successful, your doctors, your dentists, and just simply go, hey, have you ever heard of a 412 plan? 412? Nope. Your accountants who do tax returns for business owners. Teach them to find people for you. Yep, you were going to say? All right. If not, Colleen, do you have anything you wanted to share with the group? Oh,
I do
guess-
not.
All right. Thank you, everyone.
Thank you.
Thank you. Drive safe, Dennis.
I will.
Have a good day, all.